Hey everyone, welcome back to the channel. Today we're tackling a controversial topic, but it's one that sits right at the intersection of geopolitics, technology, and value investing. Everyone wants to invest in the green energy revolution. It's one of the few undeniable secular growth trends for the next 3 decades. And for most Western investors, that means buying us base solar stocks, names like First Solar or Enphase. They feel safe, they're domiciled in the US, and they're direct beneficiaries of friendly legislation like the Inflation Reduction Act. But what if I told you that this safe trade is actually the riskier bet? What if I told you that the real opportunity, the one with a greater margin of safety and a more dominant long-term position, lies exactly where most investors are afraid to look? Today I'm making a case for 5 reasons why Chinese Solar Street stocks are a better buy than their US rivals. I know what you're thinking, China. Are you crazy? What about the tariffs? The political risk? The delisting fears? We are going to address every single one of those. But as investors, our job isn't to follow the headlines. Our job is to find assets that are mispriced. And right now, the fear surrounding China has created, in my opinion, one of the most significant mispricings in the entire global market. The US stocks are pricing in perfection, while the Chinese stocks are pricing in a catastrophe that isn't happening. So let's get straight into the data. The first reason, and it's the most important one, is absolute supply chain dominance. It is impossible to overstate this point. This isn't a situation where China has a slight lead. This is a situation of total, crushing, and virtually unassailable dominance over every single critical step of the solar manufacturing process. Let's break down that supply chain. It starts with polysilicon, the ultra-pure raw material. China controls over 80% of the global supply. Next, that polysilicon is melted and formed into ingots, which are then sliced into paper, thin wafers. China controls 97%. Let me repeat that, 97% of the world's solar wafer production. From there, the wafers are turned into solar cells, the part that actually converts light to electricity. China's market share, over 85%. And finally, those cells are assembled into the finished solar modules or panels that you see on rooftops. China's share, over 80%. This isn't a moat, it's an ocean. The entire global solar industry flows through China, whose companies, by contrast, are niche players. First Solar is a fantastic company, but it's an outlier. It uses a different technology, thin film cadmium telluride, precisely to avoid competing with China's silicon-based supply chain. It has successfully captured a protected slice of the US market, but it is just that, a slice. It doesn't compete in the global mainstream. Other US hopefuls are trying to build new factories spurred by the IRA, but they are starting from zero. Think of it this way. The US is trying to build a brand new vertically integrated car factory in the middle of the desert. China doesn't just own the car factory, it owns the steel mills, the rubber plantations, the glass manufacturers, the microchip fabs, and all the highways that connect them. This dominance wasn't an accident. It was the result of 2 decades of focused industrial policy, $1 trillion in state-backed investment, and a brutal internal war of consolidation that bankrupted hundreds of weaker players and left only the most efficient, scaled, and ruthless giants standing. You cannot replicate this ecosystem in the US or Europe in 5 or 10 years, even with hundreds of billions in subsidies. It's too complex, too integrated, and too far ahead. Any serious investment in the global solar boom has to acknowledge that the infrastructure for it is Chinese. This leads directly to the second reason, an unbeatable structural cost structure in a business that produces a commodity. And let's be clear, a solar panel is a commodity the lowest. Cost producer always wins in the long run, and China's cost advantage is not just a small gap, it's a structural chasm. This advantage comes from 3 places. First, simple economies of scale. When you produce 97% of the world's wafers, your cost per wafer is microscopic compared to a new entrant building its first factory. The gigafactories in China are so large, they make Tesla's factories look modest. We're talking single facilities with 50 gigawatts of annual capacity. The entire US manufacturing capacity goal under the IRA is to hit 30 gigawatts by 2024. One Chinese factory is the entire US ambition. That scale is a weapon and it crushes unit costs. Second, energy costs. Manufacturing polysilicon and wafers is one of the most energy-intensive industrial processes on Earth. It requires cooking sand at incredibly high temperatures for days. Where have Chinese producers built their factories? In regions like Xinjiang, Inner Mongolia, and Yunnan, right next to the world's cheapest coal mines and largest hydroelectric dams. They receive heavily subsidized rock-bottom electricity prices that are a fraction of what a factory in Arizona or Ohio would have to pay from the US grid. Third, and most importantly, is the cost of capital. This is the killer. When a US company wants to build a $2 billion factory, it has to go to the capital markets. It issues high yield bonds, it borrows from banks at high interest rates, or it dilutes its shareholders by issuing new stock. All of this is incredibly expensive and weighs on the balance sheet. When a Chinese giant like LONGi or Jinko wants to build a $2 billion factory, they get a phone call from a state-backed bank offering them a 20-year loan at 1.5% interest. They are often given the land for free by the provincial government along with tax breaks for the first 10 years. How can a Western company beholden to quarterly earnings and market rate financing ever compete with that? It can't. This is why, even with tariffs, Chinese panels shipped from Southeast Asia are still landing in the US at prices 30 to 40% cheaper than what US producers can offer. The all-in manufacturing cost for a top-tier Chinese module is already pushing below 15 cents per watt. US producers are celebrating their goal of one day getting to 25 cents per watt. It's not a fair fight. It's not capitalism versus capitalism. It's Western market capitalism versus Chinese state-backed industrial policy. And in a commodity game, the latter is designed to win on cost every single time. This brings me to the third reason, which is where this becomes a true investment thesis. Absurdly cheap valuation and the margin of safety. This is the core of the argument. Because of all the fear I mentioned, the political noise, the delisting threats, the trade wars, Chinese solar stocks are trading at valuations that are, frankly, ridiculous. The market has priced in the risk and then priced it in again and then probably a third time. Let's look at the contrast. A US darling like First Solar often trades at a forward price to earnings FAE ratio of 20, 25 or even 30. Investors are paying a massive premium for the safety of it being a US company and its direct exposure to IRA subsidies. An inverter company like Enphase might trade at 40 or 50 times earnings. These are priced for perfection. Now, let's look at the Chinese global champions. Jinko Solar, Trina Solar, Canadian Solar, LONGi Green Energy Technology. What kind of multiples do you see? You'll regularly find them trading at a P/FI ratio of 8 or 6 or even 4. Let me be clear. You are buying the global number one or number two market leader, a company with dominant technology, massive scale, and double-digit growth for a single-digit P/FI multiple. You'll find them trading at or sometimes below their tangible book value. This means you are essentially getting the entire global business, the R&D, the brand, and the growth for free, and just paying for the hard assets, the factories, and the inventory. This is what value investors call a margin of safety. The market is terrified of the China risk. But let's critically examine that risk. The big one is the delisting risk from the HFCAA, holding foreign companies accountable acts. This was a real threat, but what's the reality? Most of these major companies have already solved this. They have completed dual listings on the Hong Kong Stock Exchange or on Shanghai's Star Market. The ADRs in New York might go away, but the company doesn't. Your ownership just converts to the Hong Kong shares. The risk has been neutralized, but the risk discount in the price remains. The second risk is geopolitical tariffs or sanctions. This is real, but look at the corporate response. These companies are not stupid. They have spent the last 5 years diversifying their supply chains outside of mainland China. They have massive new factories in Vietnam, Malaysia, Thailand, and even building them in the US, like in Texas or Arizona, to service the US market directly and take advantage of the same IRA benefits as their US rivals. So you have a situation where the Chinese company is capturing the upside of US subsidies, neutralizing the tariff risk, and still trading at a 70% discount to its US competitor. The fear has created the opportunity. You are being paid through a dirt cheap valuation to take on a risk that is already widely known, priced in, and actively being mitigated by the companies themselves. If you're finding this deep dive analysis valuable and you appreciate this kind of counter-narrative, data-driven investing, please take 1 second and hit that subscribe button and make sure you turn on the bell notifications. It's the best way to support the channel and it costs you nothing. And if you're getting value, tapping the like button really does help the algorithm show this video to more people who might be interested in this kind of financial breakdown. It makes a huge difference. Okay, let's move to reason number 4. They are no longer the followers. They are the technology and R&D leaders. There is a very lazy, outdated narrative in the West that China just copies technology and competes on cheap, dumb manufacturing. That might have been true in 2005. It is dangerously false today. In the solar industry, Chinese companies are now setting the global technology roadmap. The West is trying to catch up. For the last decade, the global standard for solar cells was called PERC, passivated emitter and rear cell. Now, the industry is in a massive, expensive upgrade cycle to the next generation of high-efficiency N-type cells, primarily TOPCon tunnel oxide passivated contact and HJT heterojunction. Who is leading this multi-hundred-billion-dollar transition? Not First Solar. Not any US company. It is the Chinese giants. LONGi, Jinko, Trina, and Jia Solar are in a technology arms race against each other. Their R&D budgets are measured in the billions of US dollars. Annually, they are filing thousands of patents. They are poaching the best German, Australian, and American PhDs. This R&D spend and manufacturing scale allows them to iterate at a speed that is terrifying. While a US company might spend 3 years planning and building one new factory for a new technology, a company like Jinko will convert 50 gigawatts of its existing factory lines from PERC to TOPCon in 18 months. They have achieved a velocity of innovation that Western firms with their cautious capital allocation simply cannot match. They are consistently breaking world records for cell efficiency month after month. First Solar again is a good company, but its cadmium telluride technology is a niche. It has advantages in very hot climates and has a lower carbon footprint, which is great. But it has a hard ceiling on its efficiency, one that N-type silicon cells have already blown past. CATL simply cannot compete with the mainstream silicon technology on a path of rising efficiency and plunging costs. When you buy a US solar stock, you are betting on a protected niche technology. When you buy a leading Chinese solar stock, you are betting on the dominant mainstream technology platform that is improving the fastest and already owns the world. You're betting on the R&D leader, not the follower. This brings us to the 5th and final reason: exposure to the real global market, not just a protected niche. This is the point that truly separates the two. US solar stocks are fundamentally a play on one single thing: US government policy. Their entire valuation is propped up by the tariffs that keep their cheaper competitors out and the subsidies from the IRA that make their expensive panels economical. They are, in essence, protected utilities. They have almost zero market share outside of the United States. This is not a strength. It is a profound weakness. It's a single point of failure. What happens in a few years if a new political administration takes power and decides the IRA is too expensive? What if they gut the subsidies? What if they sign a new trade deal that reduces tariffs? The entire bull thesis for our solar stocks evaporates overnight. Their stocks would collapse because they cannot compete on a level global playing field. Now, look at the Chinese companies. Yes, the US is an important market and they are fighting for access, but the US is only 15% of the total global demand for solar. Where is the other 85%? It's in Europe, which is desperately trying to get off Russian gas. It's in the Middle East where states like Saudi Arabia and the UAE are building some of the world's largest solar farms. It's in Brazil, South Africa, Australia and India. It's in Southeast Asia. These markets are not subsidized like the US. They are hyper-competitive, price-sensitive markets, and who sells 90% plus of the panels to all of them? This gives the Chinese companies a level of diversification that their US rivals can only dream of. If the US market closes, it's a headache, but it's not fatal. They pivot and ship more panels to Germany and Spain. If the EU launches an anti-dumping investigation, they pivot and focus on the Middle East and Latin America. They are already geographically diversified across their manufacturing and their customer base. The US stocks are the safe bet that is actually a fragile policy, dependent gamble. The Chinese stocks are the risky bet that is actually a robust, diversified, global, anti-fragile business. So let's tie this all together. When you're comparing us and Chinese solar stocks, you are not comparing equals. On one hand, you have the US rivals. They are protected, high-cost niche technology players, almost entirely dependent on the continuity of favorable US laws. And for this privilege, you are paying a premium valuation of 20 or 30 times earnings. On the other hand, you have the Chinese champions. They possess total supply chain dominance. They have a structural and unbeatable cost advantage. They are the new R&D and technology leaders. They are geographically diversified across every major market on Earth. And for this, you are being asked to pay a crisis-level valuation of 5 or 8 times earnings. So the choice is clear. The fear of China has created a classic value investing opportunity. You get to buy the global winners at the price of the losers. You are buying a dominant asset that is mispriced due to fear, while everyone else is paying a premium for a protected fragile asset that is mispriced due to hype. That's my thesis. But this is a complex issue, and I want to know what you think. What's the biggest flaw in this argument? What's the one risk I'm not taking seriously enough? Are you investing in the green revolution? And if so, are you looking at the US names or are you finding value in the Chinese leaders? Let me know your entire takedown in the comments section below. I read every single one and I'm genuinely curious to hear the counter arguments. Thanks for watching and I'll see you in the next one.